Welcome to the second edition of Money Hangout. This is brought to you by Birla Sun Life and Investor Education Initiative. Uh, Last week we talked about why saving is not enough, and so a lot of people save. They save it for the future, but saving is not enough. You have to put your money to work, and your money should be working harder. And for that, investing is important. But there are a lot of barriers to it. The key barrier I will list it down based on the numerous questions that we have received over years for people who are anxious about how to get started, the kind of problems that they face, the kind of questions that they have, the kind of complexity that they face. I've just listed, a set of things which I'm going to share with you. You will find them useful, hopefully, and uh, and I will also try and explain you why saving, how to move beyond saving and make your investment work harder, and what kind of difference it can make. Uh, Most people start saving and they think that things will be taken care of automatically because you have been able to save for the future. It doesn't work like that. If you save and the money lies with you and it is not growing rapidly or growing well, then it will not be able to beat inflation. It will not be, and if it is not beating inflation effectively, even if you are earning 5% return and the inflation is higher than that, your money is going down. So it's very important for your money to be able to catch up, hold its purchasing power and possibly beat it. And the way to do it is you start investing. You start investing thoughtfully. The first step towards that is dividing the saving that you are doing into two parts. One is the money which you are likely to need anytime. It could be an emergency fund or a need to spend in any time period less than 2 3 years. That is the money which should be lying in a either in your either bank deposit or a recurring deposit or in any other fixed income form, so that there is no uncertainty with that money which you are likely to need for in near future. The money which you are unlikely to need in foreseeable future, couple of years, for your retirement, for your child's education, or maybe for no other purpose, you just want to be financially well off, that money should be finding its way methodically. But there are a lot of problems to it. The biggest barrier which investors face is that when you are getting started at an early stage, your small saving is very small, and you think that you need to have something meaningful. Till you have accumulated some savings, what's the point of investing? That is a mistake. I'll just explain you the steep cost, the huge cost of even a small delay. Somebody, think of, if someone was investing 5,000 rupees when he was 25 and kept doing that till he retires at 60. This and if this money earns 12% return, which is not a very substantial return, it would have been achieved with very low risk in the last 35 years. Then this money would have accumulated to something like 5.8 crore. 35 years of 5,000 rupees regular investment making earning 12%. If somebody would not have done that at the age of 25 but just postponed it by another 5 years and started at age of 30, that will accumulate just about 3.2 crore, which is a huge difference. You have missed out the initial 5 years of 5,000 rupee monthly investment, which is hardly anything, which is just a difference of your contribution of 3 lakh rupees. That translates into a difference of 3 crore rupee in 35 years time. So there could be a huge cost of even a small delay. Get started, and investing is a saving is a habit. Likewise, investing is a habit. Form that habit as early as possible. But there are a lot of barriers when you get started. One is that you should have enough, then you will get started. Don't do that. Start now. How to go about doing it? You have great complexity. There are few thousand mutual funds. Then you have other alternatives as well. You have the recurring deposit, you have the PPF, you have the bank deposit, you have various bonds. Uh, as I said, that divide your money, the money which you are likely to need in a couple of years' time. That money should be finding its way into fixed income investment, whether it be a bond fund or a recurring deposit or a bank deposit or maybe money for a few months or few days. It should be in a liquid fund or maybe even in your bank account. But money which you are unlikely to need for a few years, you should follow two rules. One is, keep it very simple. If you are a taxpayer, choose a tax saving fund, and choose a tax saving fund quickly and get started. There is a great value in getting started quickly, as I explained you. If you are not a taxpayer, then choose a balanced fund. These are more stable. They don't go up and down wildly, and this is a great way to start for anybody who has no experience of investing in the market, which can be very volatile at times, and it could be very injurious to somebody forming a habit. So, an investor, not a taxpayer, should start with a balanced fund. And if you are a taxpayer, start with your tax saving fund. Which ones to choose? Uh, keep a simple rule. Choose any fund from our universe of top rated funds. And there is a great value in getting started rather than, and if you even if you're not choosing the best fund, and it is not possible to actually choose the best fund beforehand, you have to see that which will be the best fund after you start investing. So if even if you are with a not so great fund but a good fund, you will be well off. It won't be hugely different from a not so yeah, from the best fund in its respective category. So this is the way to start. Important thing is that you should not be investing lump sum. You should be investing regularly. That is as important as getting started. And once you have done these things, then you have another problem that the design of mutual fund. A lot of investors, there it is actually a frequently asked question that every fund comes in two formats. One is a dividend plan, the other is a growth plan. As I said, that you are investing your long-term money, the money which you are unlikely to need in foreseeable future. That money, so you should consider investing in any equity fund or any market-linked investment for the long term. Choose the growth plan. It's simple. All your returns will accumulate. You will not be getting any dividend, and that should be the goal. You should accumulate your savings to translate into something substantial rather than deriving periodic income while you are still investing regularly. Another complexity, not complexity, but some sophistication that has come, that if you need somebody's help, then there is a regular plan and then there is a direct plan. If you are sure about your discipline and you are confident that you can do these few steps to begin with on your own, then it makes sense to go with a direct plan. If you will need somebody's help in choosing the fund, helping you do the legwork, or helping you get started, then you need an advisor. There is a difference. The direct plan costs little lower than the regular plan. But once again, I would say that somehow get started. If getting started on your own is getting difficult, get started with an advisor. That difference uh, will be meaningful over a long period of time, but it is much better than not getting started at all. Then comes, how should you go about investing once you have the money in your bank account, you have decided to follow these steps, and you are ready to go. What you should do? First and foremost, you two things which are essentially needed. Of course, besides having money in your bank account, you need a bank account, and then you need a PAN card. Once you have, and if these two things are handy, then you are ready to go. Most mutual fund companies' website enable eKYC. Today, if you have these things handy, then you can do your KYC, and then that is a one-time exercise. Once you are, the KYC is a procedure which fund companies have to follow, and that is mandated by the law to comply with the Money Laundering Act that we have in this country. They have to really identify that you are a real person. And so once this exercise is done, you have to do it just once for investing in mutual fund, and after that you can invest in any other mutual fund. Once you do this, and if you have if you have online access to the bank account, you can also invest online. You can set up your SIP. You can also set up a little more sophisticated SIP, which is called step up SIP. We always think in terms of saving 5,000 rupees, but over a long period of time, your income rises, and that is what you should plan for. If you are expecting your income to rise by 8%, 10%, or something like that, choose a step up SIP so that on an annual basis, your investment contribution or your scale of investment rises with time. So best of luck. Get started now. There is a huge price to be paid if you don't start early. I wish you very best in getting started. Don't delay it any further. There will be besides this, I would like to say that most of the time investors are anxious about the market will go up, the market will go down. Should he start now? Should he wait for some more time? Stop waiting, start now.